Today, intangible assets account for more than 87% of all company value. If you look at the S&P 500, the broadest measure of the market, we can see that intangible assets are the primary drivers of earnings growth in virtually all businesses outside the real estate sector. So if these assets make up the majority of value in almost every company today, why do we not hear more about them? Why do companies still focus so heavily on fixed intangible assets? The answer is actually quite interesting. Number one, humans have an innate cognitive bias. We tend to prefer physical objects. That's simply built into the way we think. 2.5 million years of human evolution teaches you that you don't get killed by an imaginary tiger, you get killed by a real one. So we are hardwired to prefer physical objects. The second reason has to do with accounting standards, which essentially ignore intangible assets. These assets are either one, completely off balance sheet, or two, they are listed under the amorphous term goodwill, because we don't know what else to call that value. Or three, when they do occasionally make the balance sheet, they will be listed at cost. The problem with cost is that there is effectively no correlation between the cost of an intangible asset and its value, which makes cost a terrible measure of the actual value of an intangible asset. Warren Buffett famously said that accounting is the language of business, which is correct, except that in today's knowledge-based economy, that language is inadequate when it comes to describing intangible assets. It was okay 40 years ago in 1975 when intangible assets only accounted for 17% of company value. We could get away with ignoring them. But today, they are 87% of all value. This has led to an enormous gap opening up between, on the one hand, what company accounts say, and on the other, the reality of value and growth and risk in a company. This is particularly problematic because company accounts drive company reporting, which in turn drives three fundamental factors: capital flows, management behavior, and regulatory behavior. What you end up with is a situation whereby the company accounts and the company reports on which they are based are inadequately describing what is truly driving the profitability and growth of the organization and the reality of what most companies are experiencing day to day. An example of this can be seen through Nortel. Nortel was once the darling of the Canadian Stock Exchange, but in 2009 it went into bankruptcy. The investment bank managing the transaction, Lazard, did all the usual things. It sold off all of the fixed assets and cash and netted themselves $3.2 billion. The last assets to be sold was Nortel's patent portfolio. Now, patents are useful because they are one of the few intangible assets that do occasionally make the balance sheet, and they're traditionally listed at cost. In terms of the Nortel patent portfolio, they were listed on the balance sheet at a cost of $31 million. Estimates of their actual value range significantly, with the highest market estimate being $1 billion, which most people thought was a completely unreasonable estimate. Ultimately, Nortel's patents were sold at auction for $4.5 billion, 131 times the value on the balance sheet. In fact, the patents ended up being worth more than the entire rest of the company, a scenario that is not actually as unusual as it sounds. What we frequently find in intangible asset-rich companies is that there can be massive distortions between what the value of the intangible assets are on the balance sheet and what their true value really is. For those that realize that the balance sheet is no longer an entirely reliable indicator of value, companies will sometimes try to look to the P&L. However, the P&L can be equally misleading. Baruch Lev, Professor of Accounting and Finance at New York University's Stern School of Business, illustrates this problem. Professor Lev asks you to imagine two companies. Both these companies start out with $10 million, and they both want to learn how to manufacture or produce product X. Company A makes a decision to take that $10 million and spend it on R&D so that it can manufacture product X. Company B takes that $10 million and it acquires intangible assets so that it can manufacture product X. Both companies end in the same place. Both have expended $10 million and both can now manufacture product X. However, in the case of Company A, the R&D is likely to show as an expense in the P&L, which will depress earnings. In the case of Company B, the purchase will show as an asset on the balance sheet, thereby enhancing company value. Now, from an investment perspective, Company A looks like it's underperforming relative to Company B, but it's not. They're actually identical. Extrapolate this issue out across the economy, and this creates major problems and leads to distorted capital flows and management and regulatory behaviour that I talked about earlier. The takeout from this is that neither the balance sheet nor the P&L adequately describe and account for intangible assets. This is a real problem if you are a shareholder or if you are the manager of a company that is rich in intangible assets. And considering that more than 87% of company value today is driven by intangible assets, this scenario applies to almost every company today outside the real estate sector. In order to adequately describe your economic reality, the first thing a company needs to do is to identify what its intangible assets actually are. Once management teams identify what those assets are, they are then in a position to start figuring out what the risks to those assets are and what the assets are worth. Then, once the value of those assets is understood, management are finally in a position to unlock the value of these assets, whether by better utilising them internally or via external applications such as selling, licensing or financing them. However, it all goes back to one simple point. You first have to know what your intangible assets are. Without that, you're ignoring most of your value and most of your risk.